Zions Bancorporation is trading at $46.93, a staggering drop of $7.10, putting it down over 13.14% in today's session alone. When a stock, especially a significant regional bank, falls by double digits in a single day, the immediate assumption is catastrophe. The market's knee-jerk reaction screams deposit flight, a credit implosion, or some hidden bombshell in their balance sheet. The expectation is that this is a replay of the banking fears we saw unfold not too long ago. However, the reality of this dramatic move is likely far more nuanced and tied to a specific recalibration of future earnings potential in a stubborn inflationary environment, rather than an imminent solvency crisis. The market is pricing in a worst-case scenario for net interest income, but it might be completely ignoring the fundamental stability of Zion's core operating regions and the quality of its loan book. This disconnect between the panicked perception and the underlying business fundamentals is where opportunity and risk truly lie for investors, whether they are making quick trades on the Robinhood app or building a long-term position through Fidelity investments. The narrative that has taken hold today is one of severe margin pressure. Regional banks live and die by their net interest margin, or NIM, the difference between the interest they earn on loans and what they pay out on deposits. The common belief is that with the Federal Reserve holding interest rates higher for longer, banks like Zion's are caught in a painful squeeze. They have to pay more to keep depositors from moving their cash to higher-yielding alternatives while the rates on their existing long-term loans are fixed. This expectation isn't wrong. It's a genuine headwind for the entire sector. But the reality for Zion's is more complex. The bank's management has been actively working to manage its balance sheet sensitivity. Unlike some of its peers that were caught completely off guard, Zion's has been repositioning. The market's 13% haircut today suggests a belief that these efforts are failing or are simply not enough. The contrarian view, however, is that Zion's deposit base, heavily concentrated in the economically resilient Intermountain West, is stickier than the market is giving it credit for. These are not just hot money institutional deposits, they are operating accounts for small and medium-sized businesses that have deep relationships with the bank. While some investors using SoFi Invest might just see a scary headline and sell their banking ETFs, a deeper analysis of deposit composition shows a resilience that the current stock price simply doesn't reflect. Let's dissect today's brutal price action. The trading volume accompanying this drop has been immense, several times its daily average. This signifies institutional selling. Large funds are likely de-risking and rotating out of rate-sensitive names. This isn't a slow bleed, it's a capitulation-style move. This is the kind of price action that triggers stop losses in automated systems like a Schwab Intelligent Portfolio and forces portfolio managers to liquidate positions. The options market is telling a similar story, with a massive spike in the volume of put options being bought, signaling that traders are betting on or hedging against further downside. Yet within this storm of selling, we must ask who is buying. Are value-oriented funds stepping in, seeing this as an overreaction? Are insiders adding to their positions? Those are the data points that will emerge over the coming days and weeks. For the retail investor managing their individual brokerage account, it's a critical moment. Following the institutional herd out the door is one strategy, but questioning the herd's panic is often where alpha is generated. The intense selling pressure is the reality, but the reason for it, a forward-looking fear about margins, not a present-day crisis, is an expectation that might be overblown. Sophisticated traders on platforms like Interactive Brokers, known for its professional-grade tools, are likely modeling various interest rate scenarios to determine if this sell-off has pushed Zions into deep value territory. To understand Zions properly, you have to understand that it's not a monolithic entity. It's a national association operating a collection of affiliate banks under local brand names, like Zions Bank in Utah and Idaho, Amegi Bank in Texas, and California Bank and Trust. This model gives it deep roots in communities that are, for the most part, performing better than the national average economically. Its business model is fundamentally conservative, focused on commercial and industrial lending, commercial real estate, and owner-occupied real estate. This isn't a bank making huge bets on volatile tech startups. The expectation might be that its commercial real estate portfolio is a ticking time bomb, just like every other bank. The reality is that Zions has a granularly diversified CRE book with a manageable exposure to the much-maligned office sector and a healthier concentration in areas like multifamily housing and industrial properties in strong demographic regions. Past performance, particularly its navigation through the 2008 financial crisis, shows a management team that is prudent, if not aggressive. While past results are no guarantee, they provide context. The bank has a long history, and its recent quarterly reports, prior to today's guidance-driven panic, showed stable credit quality and a well-capitalized position. The tools available through Fidelity ETFs and Fidelity mutual funds offer broad exposure to the financial sector, but a direct investment in a single name like Zions requires this deeper, more specific business model analysis. Looking ahead, the path for Zions Bancorporation stock is defined by this tension. The bear case, the market's current expectation, is straightforward. Persistently high interest rates will continue to compress NIM, loan growth will slow as the economy cools, and any meaningful uptick in unemployment could lead to credit losses in its loan portfolio, particularly in small business and CRE loans. In this scenario, the stock may languish or even fall further from here, and today's 13% drop is just the beginning of a painful repricing. This is the scenario that has traders on every online investment platform on high alert. The risk is tangible, and ignoring it would be foolish. This is the narrative driving the institutional exodus and the fear you see reflected in the price. Comment below with what you think Zion's biggest risk is right now: commercial real estate exposure or net interest margin compression. However, the bull case, which represents the potential reality that the market is ignoring, is compelling. It hinges on three key points. First, that interest rates will eventually stabilize and begin to fall, providing significant relief to the bank's funding costs and boosting its NIM. Second, the economic strength of its core geographic footprint in states like Utah, Arizona, and Texas will allow it to outperform peers located in less dynamic regions, leading to better-than-expected loan performance. Third, at this beaten-down valuation, the stock is pricing in a severe recessionary outcome. Any data that suggests a soft landing for the economy or resilience in Zion's loan book could trigger a violent snapback rally. For those who invest online, identifying these moments where market expectation has become overly pessimistic is key. If Zion's management can demonstrate continued deposit stability and controlled credit quality over the next few quarters, the current price will look like a historic bargain in hindsight. Investors using the research tools on the Fidelity mobile app or other top-tier investing sites should be closely monitoring the bank's quarterly reports for evidence supporting this counter-narrative. In conclusion, the dramatic collapse in Zion's stock today is a textbook example of market expectation colliding with a potentially more stable reality. The expectation, fueled by macroeconomic fears, is that the bank is on the ropes, facing an insurmountable margin squeeze and a looming credit crisis. This narrative is easy to accept and explains the panic we've seen. But the deeper reality is that of a well-capitalized, conservatively managed, with strong regional positioning that is navigating a difficult but not impossible operating environment. The selling is real, but it seems to be pricing in a catastrophic outcome that may not materialize. The disconnect isn't about whether the bank faces headwinds, it certainly does. It's about the magnitude of those headwinds versus the bank's ability to withstand them. The market is screaming fire, but a closer look suggests the situation may be far more contained. Understanding this gap between perception and fundamental reality is the essential task for any investor considering Zions Bancorporation today. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Like, comment, and share this video to support the channel. Thank you.